All right, guys. So there's a special Infinite Banking edition here. We're gonna put it on YouTube. Create Tailwind, and we have Jim Oliver and Harper Jones. So Jim, you go ahead and take it away, man.
All right, sounds good. Thank you, Oscar. Let's just start off infinite banking concept. This is the number one book for you to read about the infinite banking concept. It's called Becoming Your Own Banker by R. Nelson Nash, the godfather of infinite banking, and everyone else is kind of an imitation of his original message. They call it different things, but we, in honor of Nelson, we call it infinite banking like he named it. And here's our little disclaimer. We're going to talk about some tax things. We're going to talk about some legal things, but we're not going to give you specific legal or tax advice because we're not licensed to do that. So this game, Oscar, this game, when we learned, everybody's played Monopoly at one time or another, but I think we learned to play the wrong way. In fact, what we're taught is whoever's got money on the side of the board, the most money on the side of the board, they're the ones winning the game. Because we look around and say, wow, look how much money they have. But that's not how you win Monopoly. You win Monopoly by getting your money on the board. And there's only one rule in Monopoly that matters, and it's 4 houses equal 1 hotel. Because if I get hotels on this corner of the board, this side of the board, or this side of the board, I'm going to take all the other players' properties. I'm going to bankrupt them. And I don't have to have the high dollar properties. I just have to have hotels on those properties, right? So that's how you win Monopoly. But the reason I start with this is that there are people out there that are playing the real game of money, and they're playing so well, you don't even realize they're playing. They're playing a different game. We're taught to put our money in Wall Street, let the banks use our money, pay our taxes to the IRS, and not try to minimize those things. We're taught to be what they even call it good citizens. Well, to me, it's like good sheep, right? That's not what we should be doing. So Bertrand Russell, who was a British essayist, he said, many people would rather die than think. Actually, that's the way it happens. But I like the way that Thomas Edison said it. He says 5% of the people think, 10% think they think, and the other 85% would rather die than think. So why would people rather die than think? It's kind of crazy. So we have to start thinking. Nelson used to say it's all about how you think, and everything in life really is, right? So in economics, there's the seen, what they want us to see. Then there's the unseen, beneath the surface, what they don't want us to see. All right, who's they? The government, Wall Street, and the banks. Now, I'm not anti-government or any kind of conspiracy theory thing here, but the IRS is the biggest thief in the world. Wall Street, we're taught to put all of our money with Wall Street and let them make money on our money. We're taught to put all of our money in the banks and let those banks make money with our money. But we're not taught how to be financially independent, financially free. That's not what we're taught. We're trained to be sheep and to be in the herd. But the reason I'm using this overused what is this, Harper?
Iceberg.
I was on mute. Iceberg.
An iceberg. Sorry, and that was just had a brain lock there. The reason I'm using this overly used iceberg analogy is that icebergs in nature can flip upside down, and when they flip, the unseen becomes seen. And once you see it, you can't unsee it. Okay, here are some of the things that I'm talking about. Constant compounding and the power of constant compounding. Guaranteed growth, tax-free. Or, think of it like tax invisible. Multitasking dollars, control liquidity and use, which is what a bank wants. They want to control our money, have liquidity of our money, and use our money, right? And then creating velocity of money. And I'm going to show you all of these things and how we can use these things to take back the banking function in our lives. But first, we have to understand a few things. And one is the reason that most people have never heard of this is most people are taking financial advice from salespeople in Wall Street, et cetera, instead of rich people. And we're going to look at the methodology of wealth from a rich person's perspective. What do the rich people do? What do rich corporations do? What do banks do with their money? Now, Nelson says in his book, if some authoritative power distributed all the money in the world equally among all the people in the world, within 10 years, 97% of all the money would be under the control of 3% of the people. Now, I believe that's true, right? There are people out there right now that want to spread the wealth equally. But what they don't realize is that in 10 years, 3% of the people are going to have control of the money because they understand how to get money to flow to them instead of away from them. Now, all of the financial entertainers like Dave Ramsey, et cetera, what they want to do is slow down this flow away from you. What we want to do is turn it around. We want money to flow back to you. Okay, and we're going to talk about how to do that. So it's, the thing about money is, have you ever felt like this? Well, what I'm doing with my money doesn't seem right, but everybody else is doing it. So if we're all going down, we're all going down together, right? The herd mentality. That's the reassuring lie. And the reason I like this cartoon is that I kind of imagine that we're going to the movie theater. We pull up to the theater and there's two different movies playing and they're about money. Okay. Not climate change. This one is a Al Gore title, An Inconvenient Truth. But these are about money, an inconvenient truth about money and a reassuring lie about money. Everybody's standing in this lie line and their parents are even bringing their children to stand in that line. So to stand in this other line by yourself, takes courage, confidence, and coaching. Now, if you're in real estate, you're standing in that other line. Everybody's telling you to put money in a 401k and everything else. And you're saying, that just doesn't seem right. Right. And you get coaching from various forms and sources. And that's really, really important. So when we're thinking of changing our mindset on money, our thinking, one concept is we have to focus on volume of interest, which means it's the amount of interest paid in each payment over the lifetime of the loan that matters, not the rate. The rate's a distractor. Volume of interest is what's important. It's kind of like this. You go to the doctor to get an injection. It's not the rate or how fast they inject you that matters. It's the amount of medicine or the volume of medicine in the syringe. Not enough might not do anything and too much might kill you. All right, here's another concept. You give up interest or investment returns you could have earned somewhere else, even when you pay cash. Okay, that's lost opportunity cost. Now, to explain lost opportunity cost, I like to use an example that's not a real world example. But it's kind of like if we were going to look at a photograph and we wanted to see the tiniest detail of the photograph. We'd blow it up as big as we could get it so that we could see the detail. So that's kind of what I'm doing. I'm blowing this thing up. So let's say that we had a penny and we could double that penny every day. And it goes along and it starts to build up steam and momentum. But on day 22, we need to go buy a new car. We're going to trade in our old car and we need $21,000. So we take the money out of this account. All right, what happens to our compounding day 23 to day 31? It starts over. What do we end up with? Not much, because we interrupted the compounding. But what if we didn't interrupt the compounding? What would we have after day 31? $10,737,000. That's the power of uninterrupted compounding or constant compounding of your money. Now, again, I know this isn't a real life example, but can you imagine 5%, 7% over a 20, 30, 40-year period, it's significant. And that's what we're trained to do, is interrupt our compounding. And we have financial entertainers, again, like Dave Ramsey, saying pay cash for everything. Really? There's got to be a better way. I mean, the bank doesn't use their own cash. Why would we? So we have to accept that we finance everything we buy. We either pay interest to someone else or we give up interest we could have earned somewhere else. There are no exceptions. An infinite banking concept, or IBC, is how to create your own banking system so that you profit from banking instead of someone else. But if we're going to get into the banking business, we need to know how banks make money. All right, so here, let's break it down and make it easy. You have a depositor. That's the first thing the bank needs. So the depositor takes money down to the bank and deposits in the bank. When they make that deposit, is that an asset or a liability to the bank?
Asset.
That's what most people say, right? Who said asset?
I did.
Okay. Oscar, it's really a liability because the depositor could demand the money back anytime they want, and they haven't done anything with it to make any money. But how do they make it an asset?
They lend it.
They lend it, right? So it's a liability, and then they lend it out, and the loan is the asset, right? Because the borrower is going to pay the bank interest, and the bank's going to pay the depositor a little bit of interest. Now, remember the seen and unseen? That's what the bank wants you to see. That looks fair until we dig just a little bit deeper. So let's say we put 10 grand in the bank, and the bank's going to pay us 0.2%, let's just say. That's $20 over the next year. But let's say the borrower is going to pay the bank 5.2%, $520. Now the consumer says, well, the bank made $500 more than me, no big deal. But that's not how a business works. You have the cost of doing business, you have your profit, you divide the cost into the profit, and you get your profit margin. Now we can see that $20 goes into 520 26 times, which means the bank made 2,600% more than you. And by the way, they did it with your money. Now that $500 doesn't seem like, oh, no big deal. 2,600%. Now, by the way, if you've got money deposited at the bank and borrowed from the bank, then it really isn't the bank making 2,600% more than you with your money from you. Now, if people understood that, they wouldn't do that, right? Okay, so Shakespeare said, if you understand the players in the play, you'll know what's going on. Now, I never really understood Shakespeare, but all right, let's just put it to test. You have the depositor, the owner of the bank, and the borrower. Now, infinite banking in a nutshell is just building a wall around this transaction. Because if you're all three of these entities, how do you lose money? How does somebody else make any money off of you? They don't. So I know some people in the audience are saying, that can't be right. 2,600% is just too high. I felt the same way when I first saw this. But guess what? These are Bank of America's numbers. And they're right out of their bank analytical report from Bauer Financial. And they analyze every bank and credit union in the United States. Now, this report is from 2016. And guess what? It doesn't change much. So let's look at it. Top highlight, interest-bearing deposits, 860 billion. Not bad. Interest expense, what they pay us, 1.8 or 1.9 billion. That's 0.2% of the 860. Interest income, what we pay them, 44.8 billion, which is 5.2% of the 860. We already know that's a 26-to-1 ratio. Is that amazing? So, want to be in the banking business? Absolutely, right? And in fact, in this type of concept, in and what we're going to be talking about today, these are the balances as of 2008. Now, why 2008? They had to tell us what they had when we bailed them out. Guess how many times they've told us what these numbers are since 2008? 0, right? They don't want us to know how much money they have in this concept. All right. Here's another way banks make money. By the way, this is a good time to say, look, we're just using math. This is a payment calculator. Anybody can get off the internet for free. Okay. Now, if you're in California or New York, I know this doesn't buy much of a house, but let's say that we had a $300,000 mortgage. If you're in Iowa or Idaho or Texas, you can buy a nice house for 300 grand, right? 5%. I know that's kind of high today, but it fluctuates. I'm just trying to keep it round. 30 years, here's my payment, $1,610 a month. And my future value calculator says if I make all those payments for 30 years or 360 months, I'm going to pay in about 580 grand. Now think about that. That means that 48 cents of every dollar that you pay in goes to the bank's benefit over 30 years. And 52 cents goes to your benefit. Where's my 5%? So let me ask you a question. If you earn $1 and you got to give somebody else half your dollar, do you care what interest rate they're charging you, or do you just care that you got to give somebody half your money? Half. Go ahead, Oscar.
Oh, I care. I definitely care.
Half the money, right? Why do I have to pay half the money, right, Herman? And so now think about this. The average mortgage in the United States is about 5 years old. That means 80 to 85% is going to the bank and less than 20% is going to you, to your benefit. And the bank wants to put you on an adjustable rate mortgage, and everybody thinks it's so they can raise your interest rate. No, they'll lower your interest rate. They want to start your amortization over again because they know it's not about the rate. It's about the volume. Harper, what were you going to say?
I said that's not even factoring in the closing costs and the refinance cost. That's just the loan itself.
Just the loan, right? Yeah, those other hidden fees are, those are just a bonus to the bank. Okay, now, but this is the key, this is the point of this demonstration or this example, is what does the bank do with that payment every month that you pay them?
They relend it.
They relend it. They loan it out as fast as they can, right? Okay. So in my calculator, if I put 5% right here, what this will assume is that every time I make a payment, they loan it out one more time. Just the limitations of my calculator. One more time for the duration of the loan. So the first payment is loaned out for the whole 30 years, the last payment for only 1 month. The same terms as this loan, 30 years, 5%, all that. On a $300,000 loan, they make over $1 million by loaning it out one more time. Now, can you imagine them loaning it out over and over and over and over again? That's called velocity of money. Now, for the engineers out there, I know that's not velocity in science, but it's in an economic term, velocity of money. That's definitely something we want to do, is use the same money over and over and over and over again. Can we do that in real estate? Absolutely. So Nelson said, if you know what's happening, you'll know what to do. So if that's what's happening, then we have to take over that banking function in our lives. Okay, so let's imagine that this is our business. The first year of our business, we put in $100,000 and we can use $62,000. Okay, now did we have a good first year? Absolutely, because we can't put in $1 million into a McDonald's and take 620,000 out, right? How about the next year we put in 100 and we could take out the whole 100? It's looking better, right? And every year after that, it just gets a little bit better and a little bit better. Okay, excuse me. So let's imagine that I put in 100,000. I have $62,000 that I can use. And I have an equipment loan at my business for $62,000. And I'm paying $6,000 a month on that. Now, it's not a 1-year loan, but that's what I have remaining, right? So I pay that off. And that $6,000 that was going to somebody else's bank, including that interest, right? I recapture that interest and I pay myself back the $72,000. All right. So the next year I put in 100,000, and I said in that other example that I would have about 100 grand. Plus I could use the 72 again, right? Just like the bank would. So I have 172,000 to use. Well, I have a tax bill for $172,000, and I was paying $15,000 a month towards that. I pay that bill off, and that 15 grand a month, I pay back to myself. The next year, I put in 100,000. I have 101,000. Remember, because it's getting a little bit better, but I can use my 180 again. And now I have a real estate investment for $281,000 that I find that's going to cash flow me $2,500 a month. Again, these are just examples. Don't try to analyze, well, is that a good deal? That's not real. It doesn't matter. It's the concept, right? I pay off that real estate, or I pay for it. And then that $2,500 a month comes back to me every single year, right? And I just keep doing this because I can use that 30 grand over and over again. I just keep doing this. Now, in the real estate side, Harper, I'm going to let you go through this.
Okay. Yeah. Sounds good. And can you go back one slide too? I want to recap.
Let me ask you this, and sorry, Harper, to interrupt, but for our audience, and I know the answer already, but when you borrow your money, does your money, that the ones that is still in the bank, right, in your bank, is it gaining interest, or
Absolutely.
what happens to the money? Okay.
Yeah, because your money never leaves that account.
Okay.
And I'm going to break that down in a little visual here in a second, but your money never leaves. It stays in the tax shelter, growing, guaranteed every single day.
Awesome.
Yeah.
Go ahead,
With this ledger and flow of money, if you take where we put the line down the middle and it says tax invisible, that's the policy. It's very private, safe, secure place to store your capital. And like Jim said, yes, it never leaves, right? And we'll break it down in some slides ahead. But that's going to do what it's going to do with the policy. That's the product. The process, which is IBC, infinite banking concept, is how we're flowing the money through that line there to the right side of the ledger. And on that right side, you're going to be financing equipment, paying a tax bill, doing real estate investments, buying a car, buying businesses already. What we're doing is we're pairing the two together. So I want to see how you see the separation. So now we can go to the next slide and we'll go through real estate. So we'll have this first slide here, and we're going to say, okay, well, we're just going to use this to build a real estate business and build some passive income. So first year, all the numbers on the left are going to be very similar, right? Depending on what you're flowing back from your cash flow and assets. So you have 100,000, right? You got your 62,000 in cash value. We're going to take the 62,000, right? We're going to get approximately 12% return. Look, there's deals where, we're making 30, 40% cash on cash. There's deals you're making 5 or nothing the first year. I thought 12 was a good round number. And this, we got to reflect, think back, say, this is just a concept here. You could plug whatever numbers in, the right size of your behavior and your assets, and you're going to find different deals at different times, right? So this is just a concept flowing money, keeping it consistent at 12%. So we're going to take that, right? And year 2, here's what we have. We're flowing that back. I may have edited this slide right before we did it, so the numbers may be slightly off. So bear with us. But
I'll correct them as we go.
Perfect. Okay, so maybe we do get a 24%. We'll see what happens. But you flow the 7,500 back through there, right? And then you have year 2. You have your $100,000 premium, right? Then you have 100,000 of cash value from that, and then you would have approximately 110,000, right, or 107,500. We'll take that approximate 12% return I guess it would be slightly less since we don't have the 115, but we're going to have about that 13.8 and flow it back. And we're still going to have our cash flow from the year before, right? So now we have approximately 21,000 of passive income. Okay. Now the third year, our policy is starting to get more efficient, which we'll break down this in the further slides of how that policy is getting better year after year, guaranteed. And all that growth on that side, of course, is tax-free. We take the 100 from the third year, we add our cash flow that's coming in from the last year, and we go invest that. We get around that 12% return again. Great. Okay. Flow that cash flow back through. And now we're adding up the columns all on the left there. So you have about 35,000 or so. Year 4, do the same thing. And now you get that cash flow added together. And in about 4 years, right, you've created maybe about $50,000 of passive income. Maybe that's 40, maybe that's 100. It depends on the deal. You know, you could 1031 a deal. You can find other deals. You could find a better deal. But we're not teaching how to find the deal. We're teaching how to make the deal better and pairing these two together. So that's kind of like an overview. And of course, I need to fine tune some of these numbers. But once again, it's a concept, not the specific numbers we're focusing on.
And the thing that you look at here is you're putting your money in motion, right? Remember, these cash value numbers, they never leave your account. They're sitting over here on this side of the ledger growing every day. This money that you have, then you have somebody else's money that you're buying these properties with. So you're getting these properties on this side, tax favored. All of this money that you have in here is tax invisible, but you get both, right? And so if you look at your return of say $50,000 and you've got $400,000 in it, okay, and it's only getting better and it's only getting more efficient and you're just getting started, right? So, you know, when we look at it, you put in 400,000, you have $365,000 in the policy, you've created $52,000 of passive revenue. And the reason I don't say passive income is taxed at ordinary tax rates. Revenue has tax advantages. If we're buying real estate, do we have tax advantages? Absolutely. So it's not all income. All right. And it's as simple as this. You're really, when you're doing this banking system, you're writing checks to you instead of the bank. And the more that you do it, you build an ever increasing pool of money for you, your family, and your business. All right, so let's break it down. You have this very specially designed insurance contract from a mutual insurance company. And the reason it's a mutual insurance company is there's really two types of insurance companies. There's a stock company and they're owned by shareholders, and there's a mutual company and they're owned by policyholders. The owners of the business by law must receive the profits. Okay. So we want to be an owner, right? Okay. So we have this insurance policy designed for cash value. Still has death benefit and illness protection and tax-free buildup because it has to qualify as life insurance to get all these tax advantages. Okay. It grows every single day, guaranteed, tax-free. Okay. But the cool thing is that because we have this insurance contract, we have a contractual right to borrow money from the insurance company. Interest only. Okay. So here's how I think about interest only. Let's say that I would loan you $100 million today. And your only obligation is that you got to pay me $5 million of interest 1 year from today. Would you take the loan?
Yeah, one interest. Yeah.
Yeah, 5% interest. I'm going to loan you $100 million. You pay me $5 million of interest 1 year from today. You'll do that all day long, right?
Yeah. Mm-hmm.
Because you know you can go make more on it. Okay, so let's reverse it. Let's say that you made me that offer. And by the way, Oscar, I'm open to it if you're making that offer. You're going to loan me $100 million, and I'm going to take that money, and I'm going to go leverage the bank's money too. And I'm going to get another 400 million, let's just say, to make the math easy. And let's just say after debt load, everything, I can earn 5%. So I'm going to earn 25 million on the whole deal, right? I owe you 5. So I'm going to call you up 1 year from today. Oscar, and I'll fly in. I got your check. I'd love to buy you lunch and give you your check. And you say, well, Jim, you want to pay any principal? No, not really. I'll just see you next year, give you another 5 million. Right? Because I can take that 20 million, go leverage that, and on and on and on and on. Right? So my debt load to you just goes down as a percentage. Okay. Now here's something that so many people out there that are saying that they teach infinite banking, but they don't understand this, is that when you take this loan, your money doesn't go anywhere. All they do is put a lien on your cash value, and they give you their money. Okay? OPM. That's a great way to make money with other people's money. You get use and control of the insurance company's money. Okay, that's what a bank wants, use and control, right? And you go buy real estate. Regardless of how you buy it, if you leverage somebody else's money, owner or seller finance, whatever it is, it makes money. Flows back to you. Now you decide, do I want to flow any of that money back to the insurance company? Totally up to you. I could just put it right back into another deal. But if I do flow it back to the insurance company, it reduces my lien, increases my cash value available. Now, what did the bank do when we paid them back that $1,600? They loaned it out again. So we're going to do the whole process over again with somebody else's money. This time, just to mix it up, I said we're going to buy part of a business, maybe a franchise. It's going to cash flow. We have the cash flow from here and here now. All of that's flowing back. Again, if we want to pay back any principal, we can. We don't have to, but we're going to keep doing this over and over and over again. Now, what a lot of people do is they want to talk about, well, I'm going to use this system for things like cars, vacations, and taxes, and recapture that interest or lost opportunity cost, right? I use my system for that too. I like to use it for cash flowing assets like real estate, because that's my financial freedom plan. And it does not take very long, right? How people ever bought into, hey, work for 40, 30, or 20 years to build up some account that then you're going to hope that you don't run out of money before you die. Whoever bought into that, right? Whoever sold that to us was really good at sales, because we can go buy real estate and we can build up cash flow that will last forever, that will outlast us. And we don't have to manage properties and everything else. And again, we're not here to talk about why to do real estate or how to do real estate. This is just how to do real estate more efficiently. But all that money that is sitting in those policies, I can take out tax-free. So if I do want to generate an income to supplement my cash flow from my assets, I can do that. Now, here's the really cool thing. Remember the two sides of the ledger. You have the insurance contract over here on the left, and that's available tax-free. Now, by the way, for you accounting majors out there, I know that my ledger is backwards, okay? It's just the way that I see it in my brain. And so you have the policy, it has a rate of return. You have your assets and your behavior going out and buying these things. It has a rate of return. Normally you would say, well, I get the money in this account or I get this real estate. It's an or asset, but here it's an and asset. Because I get to collateralize this 100%, I get this and I get this, and I'm using the insurance company's money to buy it. I'm paying them interest only, and my account is growing every single day. Now, if I do it in real estate, here's the other thing. The interest that I'm paying in my real estate business, can I deduct that off my taxes? Remember I said I wasn't going to give you tax advice? All right, but if your CPA says you can't do that, let us know. We'll find you a new one. Because now think about this. How many things in your life that the money that you're making, you don't pay tax on? The money that you're paying, you get to deduct. Then you add all of the, the reasons why we buy real estate. Now you have tax favored over here and tax invisible over here. Now, I'm telling you, you know more about life insurance than most life insurance agents at this point, because they're taught to sell you death benefit. And it comes with a little bit of cash value, okay? We don't design the policy like that. The policy is definitely designed differently, okay? You need the right policy, the right company, strong financials, not ratings. Ratings can be bought. And I mean, we want good ratings, but AIG had all of the top ratings 30 days before they were insolvent, and we had to bail them out. The company has to be okay with infinite banking. It has to be designed for the highest cash value possible, very strong guarantees. It can't be a modified endowment contract, which means that it doesn't qualify as life insurance, and there's tax and penalties. It acts like a qualified plan. And we have to be able to get enough of the dividends and the premium to go to paid up additions riders. Now, how to screw this up? Listen to the noise, right? Think that this is a normal whole life insurance contract that one of these financial entertainers bashes. It's not a normal contract. It's what a bank and corporation does. The other way to mess it up is look short term. It takes time, and you want to start first or do you want to finish first? The other thing is that everything that we're talking about is the process, how to use it in real estate, not how to design, the policy. All these people out on the internet, they want to talk about the policy. No, what are you going to do with the policy? And then the other thing is that when it starts to leverage, do you want there to be a little bit of money in there or a lot? You want a lot in your system. Now, if you don't pay back the loan and you keep it in motion, that's fine. But if you never pay back the loan, then you can get yourself in trouble. And you want to pay higher than what the insurance company is charging you. You want to build a big system. If you were going to have a banking business, you want it to be little or you want it to be big. Okay. And the other thing is that when we use the banks, we're using the banks to go make money. We're not paying the banks. The tenants are paying the banks. We're not paying the insurance company. The tenants are paying the insurance company. And, the other thing is that sometimes people overthink it. They want to see a spreadsheet of exactly, well, show me a spreadsheet of, of all of your different real estate holdings combined. It's good for today, but it's not going to be good a week from now when you add to your holdings, right? And so if the concept makes sense, then how much money do you want to make? You want to make as much as possible, right? So it's very simple, but sometimes people like to complicate it. It's use and control of somebody else's money, putting that money in motion, doing it over and over again to create velocity of money. And it's much better than trying to take and have this money where you're going to build up this money in some kind of fund and then live off it for the rest of your life and have all of these problems. That's how you get your money onto the board and win the game and play the game the way people that really understand money play the game. Does that make sense? Any questions or anything that you want me to clarify?
Yeah. Sorry, I was on mute. Can you emphasize the fact that, you mentioned that it's a simple process, right? Can you also emphasize the fact that that it's also when you borrow your own money and you're paying it back, it's also simple.
Simple interest.
Simple interest. There you go.
Yeah. So it's interest only, which means that's a great point. Thank you. It's interest only. So it's unstructured. Means you only pay the interest. There's no volume of interest because there's no amortization, right? And if you're buying cash flowing assets like real estate, you're not going to be paying that interest anyway. Your tenants are going to be paying it. But the other thing is that there's no application. You don't have to tell them what you're going to do with the money. You don't have to tell them when you're going to pay it back. There's nothing like that. We do now. Most of the people on this call understand how to do an amortization schedule and promissory notes and stuff like that. But if you don't, we do all of that for you. And if you're going to set this up corporately, and there's some reasons to do that, depending on what you're going to be using the money for, there's waivers of board meetings and, you know, all kinds of documents that we can help you with to have in your file, so that if you ever do get challenged by the IRS, you can say, this is a legitimate loan. Some CPAs, by the way, on this loan, they get a little confused because they say, well, you can't deduct the interest when you're borrowing your own money. But are you borrowing your own money? You're not. You're borrowing the financial institution's money, the insurance company. Same as if you were borrowing the bank's money.
Got it.
The one thing I wanted to add was, and you know, I read Nelson Nash book that Harper sent me, and it's the fact that it mentions, you know, you're becoming your own bank, so you can't cheat your own bank, and you have to be able, you have that discipline to pay back what you are getting from, you know, that institution that you're borrowing against, because it's only going to do more harm against you if you don't. So this concept, while it's effective, you do have to have the discipline to go through those steps, right?
And Oscar, that's a great point. That's where the coaching comes in too. Is, you know, at CreateTail Wind, what we do is we coach, right? And you never pay us any money directly because we set up the insurance contract. They pay us a commission to do that. But you'd have to pay somebody to set that up, and you get the coaching free when you do it with us, right? So we coach you on, hey, what are you going to pay yourself back? Hey, what was the bank going to charge you? So when, excuse me, when I buy a car, I go in and I say, what would you charge me if I want to finance this? And then I get them to quote that. And then I say, okay, I'm going to wire you the money. I get the best price. I'm going to wire you the money. And then I pay myself back. I stretch it a little bit, you know, I mean, I make it a little bit higher than what they were offering, but that's just because I've been doing this a long time. In the beginning, I just did it, whatever they offered me. I just paid myself back. But because if I'm willing to pay them that money, why wouldn't I be willing to pay myself that money? Right? That's kind of what you're talking about, being honest banker, is be willing to, your money is just as valuable as the bank's money, right? To treat it otherwise is kind of foolish.
Yep.
Yeah, no, and that was my point. Is I think it's a mindset switch for most people to understand that your money is valuable too. It's not just, you don't need to be an institution for money to have value, and you have to treat it the same way. Doesn't matter if it's a cent or 100 million in your account.
Yeah. And the fact that what you're creating, and you said it so many times, is a system. You know, if you break the system, it stops being a system. So the part of being disciplined is part of that system. And you have to keep the ball rolling. You know, so
Yeah.
I mean, it goes back to, you know, like with the human body, you know, you live off water. Water's got to flow, right? Just like money's dead unless it's flowing. Now, I get storing it somewhere, right? But in the contract, instead of sitting in the bank and the bank's putting that money to work, well, the mutual insurance company is now putting it to work, and you get to have those surplus dividends and profits because you're a shareholder, you know, in that company. Whereas the bank, those shareholders are different from the customer. You only get that small interest. So, you know, when you're having it stored in there, you're getting that. Your money is at work, even if you're not deploying it in the real estate deal. Which brings me to another point. Especially right now, a lot of people have a lot of liquidity because they can't find any deals that make sense, right? And they're being disciplined, waiting for the right deal, which is smart. But how much is your money making right now sitting in a checking or savings account, right? And it's not as safe sitting it there, really, when you read about it. Is it not safe sitting in someone else's commercial bank and you're may get a couple basis points, 20, 30, 40 basis points. On the contract, you get 4 or 5% compounding tax free in a safer place while you're waiting.
Yep.
Yeah. And your family's protected because you do have death benefit. God forbid something would happen to somebody. Your family's going to stay in their standard. And think about what we're trained to do. We're trained to put our money and let somebody else use it.
Hey, Jim, can you also touch on, because this has been brought up more when people read also, the main book to read about, financing, flowing money, IBC is Becoming Your Own Banker by Nelson Nash, which if no one has a copy, they can email me at harper@createtailwind.com. I'll send it to you. But there's another book, What Were the Rockefellers Doing? A lot of people are talking about estate planning, trust, like really cool advanced stuff. And I think that's all great. I know we don't hint on that as much or like harp on it or talk about it as much because we're talking about the need for the finance right now. Although that stuff is smart to set up and plan. We don't know what's going to change over the years, but it's smart to have that stuff set up and plan. So we do also discuss and can set up more advanced, business structure and estate planning and stuff. If you want to touch on that too, Jim, why we focus more on the concept, but that we also have that arm too included.
Yeah, I mean, as you build up, I mean, it doesn't matter whether you're building assets in instruments or assets as assets, your wealth in instruments or your wealth and assets. When you are looking to put your money in a trust, here's my real simple non-legal explanation of a trust. So a trust doesn't do anything, therefore it can't be sued. And if you don't have anything, then you can't be sued. So if the trust owns everything, there you go. You're protected, right? I guess it wasn't even 30 seconds. So if we build up a lot of money and we want to pass our assets on to the next generation, well, we really don't want to just hand them a check. And, you brought up the Rockefellers. Well, the Vanderbilts, at the turn between the at like 1900, the Vanderbilts and the Rockefellers were as rich as any family today, right? But they had two different philosophies. The Rockefellers, if you wanted money and you were part of the family, you had to borrow it and pay it back, being honest banker, back to your point. But if you were a Vanderbilt, there was like this arrogance. We just hand you the money. You got it because you were part of the family. In 1993, there was a family reunion at Vanderbilt University, and there wasn't one millionaire amongst the family members. And obviously, the Rockefellers are still going strong. And even more than that, if you look at the Rothschilds, and not all the conspiracy theory stuff around the Rothschilds, but they're one of the richest families, if not the richest family in the world. They don't want you to know that. They don't want you to know anything about them. But the way that they became rich and continue is the banking business. And, banks finance both sides of wars. War is good business for banks. You can read about it. You can go back and look at history, right? And so how do you keep that money in the family for a long time? One thing might be a legacy trust, right? Or dynasty trust, I'm sorry. A dynasty trust, you just get the benefit or what the trust produces. You don't actually take over the assets. Now, and if you're like in states like South Dakota and I believe Delaware, those trusts go in perpetuity. So there's no end to the trust. And they were called dynasty trusts back in the day in Europe when these families wanted to keep their money in the family, right? And they've spread out over all the rest of the world. And today we can use those types of planning tools. Sometimes people want to talk about irrevocable life insurance trusts, and that's a lot tougher because they keep changing the laws and the exemptions and everything else. And if you told me what the estate tax laws were going to be when you died, then we can plan for it. But, I'm 55 and I would tell you that I'm too young to start planning for that. maybe 65. I don't know. Let's get some consistency. They didn't change it forever, and so we could do estate planning. But all of those things are great. But here's the bottom line: is we have to build the wealth. Then we'll talk about how to keep it.
Yep.
We'll talk about how to protect it, right? But let's build the wealth and that financial freedom, because money equals choices, choices equal freedom. That's all we want, right?
Yeah.
Yeah. No, absolutely. I think it's awesome that you provide, that estate planning aspect of it too, because that's important. But like you said, and I've talked to several people about that as well. I don't think it's necessarily the hard pressed that you need to do that at the beginning if you're starting out. The main thing that you want to do is find out how to set up your structure for the best tax incentive as you're building your wealth, and then eventually develop your estate planning once you do develop that wealth, like Jim is saying. But the main thing is really that tax advantage and building that wealth. Estate planning can come when you have actual assets and net worth. But yeah, no, I love it that you guys provide a whole round of service. It's really good.
Yeah, thank you. It's fun. I mean, I've bought 17 companies as of last week using this, or bought into, or use, and I use it with all of my companies. I've bought a lot of real estate. I mean, I guess a lot is relative, right? Depends on and and that's why we share it, is because we're passionate about it, and we're doing it, right? I've got a policy on Harper. He's got one on me. We have a company that owns some real estate, and we are protected, and we have a place to put money and to use it and to grow, and we're growing that portfolio.
Yeah, I
Great.
hear it, man. No, I like it. I like everything that you presented. Jeremy, you have any other questions?
No, no, no. I like it. You answer all the questions, and I'm pretty sure our audience and the viewers of this episode, they're gonna benefit a lot from this. And I love the concept, and this is something that I think it should be taught. Um, it start teaching as kids in schools, and as you grow, get more into it. So yeah, I think it's very beneficial, and I appreciate you guys' time.
Yeah,
Yeah,
thank
yeah,
you for having us. I really appreciate you. If you can't tell, we're passionate about this, so we love sharing it with as many people as we can.
Oh
no,
yeah,
I,
well,
I love it, and we're passionate too, man. And for the audience, this will be up on YouTube. We're gonna put a little snippet on the podcast,
yeah,
just so people know that it's on YouTube. But go ahead and leave us a review. Reach out to Harper, reach out to Jim, any of us, and we can all talk about it.
yeah. And
Awesome.
and just to reiterate, Harper said that if you reach out to him, he'll send you a book. That's true. You'll get it in 2 days. You get a book. It's an awesome book. It'll give you a lot of history and the concept. And then contact him, and he'll get on the phone with you and talk to you about it. So the passion is there. Yeah, definitely.
Awesome.
All right, guys, and we're out. Thank you so much again for coming on, and we really appreciate it.
Thank you.